Good afternoon, Scott Redler, T3Live. Welcome to today's recap. So it's Friday, the last day of the week. You're going to see the headlines of how historic this week was, how the best week perhaps since 1950, but that headline might change because we closed a little bit off the highs. You know, that comes after the worst week since 1932 going into Thanksgiving. So, all in all, there's a lot of money to be made and a lot of money to be lost. Okay, what you have to do, though, is not put yourself in the position to be on the side where there's a lot to be lost because of having opinions and being stubborn. We came into this week early on, and it did look like the rally was somewhat feeble, right? We closed on the dead lows on Friday, so it was hard to come in Monday long, so a lot of people didn't. And then you had that huge gap up. So right there was not, it was a tricky day. Then Tuesday we failed at, the 50-day. So it was a little short-term situation to get short. And I got short, including me. And then Wednesday, you had the news from the ECB, everyone getting together to do what they want to do, and lo and behold, we're up 500 points. So that was a big decision day. Are you going to have an opinion and say, you know what, this is not going to work, Europe is still going to fall apart, I'm staying short, I don't care, or, you know what, things change, quick feet, momentum now might be back to the upside, cover, which a lot of us did in that first hour, and then you got out of the way, because if you were short going into today, rolling it up from Tuesday, I don't think you made it through the day. We came in today flat, short term, a lot of guys made good money shorting today. Okay, what's some of our rules? Sell excitement. Okay, we don't buy excitement, we sell it. We don't try and sell fear, we try and buy it. So the bottom line is, on a short-term basis, gapping up into an exciting jobs number after in a historic week made sense short-term. Okay, so at this point, for the active trader, that was a nice setup. For those of you that came in flat, if we would have gapped down, it might have been a better setup to be long. So all in all, they asked me what today meant. Are people looking into the jobs number, figuring out that there are holes in it, that they fudged the numbers? No. You had a historic week, or you had a big move up into the 200-day moving average, a nice spot to take some profits, pause, and then now we have to look next week where we could potentially buy and what levels to watch to see if momentum could stay intact for more follow-through. So if you look here at the chart of the spiders, you will see that on a few different time frames we could figure a few things out. First things first, this was that Fibonacci retracement from the low to the high of that October, which came right to the 0.618%, which was right here. So granted, it didn't hold the 50% this time, it didn't hold all of these, but it held the last level, which meant rally still intact but weakening until we had that news. So you get this out of the way now. And with these boxes and with this environment, it's a little harder to really rely on these, quote unquote. Let me see if I can get rid of it. Maybe not. Okay, you know what? I won't get rid of it. I'll go to the spiders. And you can see now that here is that 50-day moving average, or actually the 200, which I was talking about. So it made sense to go from the lows to the highs for a pause. So the question is, will this pause, that sometimes is a pause, or it sometimes leads to corrective type action. So if you take that same kind of Fibonacci retracement, which I was just talking about in my chat room, and you go just from the low to the high of this week, you will see that the 38.2% is right around 122, which would be a little bit of a gap fill, and then the 0.25 is around 123.96. So meaning that this would be an area to hold for really big time momentum, and this would be an area to hold on to show strength as well. And then obviously as you go further down the spectrum, the more people will get frustrated and lose faith in what just took place and say it was a one-time wonder. So for me, I'm long very light, okay, and I think that this area is worth a look, which would be maybe a little shallow, but you know how they like to push into the gaps. You have a big upside gap here, a big exciting pro gap, and moving averages are covering up. It could still be healthy, come into this 122.50 and then continue through what is bigger resistance. But you have to kind of back up the truck a little bit, let some more people on, because this train moved very fast. So all in all, a topping tail into big resistance, that was at least strategic to short it for cash flow. So moving along, that's in the SPX, and then we talk about, if I showed you the OAHs and I show you the XLE and I show you the the XLI, which is the industrials, they all kind of look the same. They all opened up and closed on the lows, giving you a small outside day to if you were long for this week, this would be a spot to take profits based on that little bar. It's not a saying game over, it's just a spot that said sellers took control, and the excitement wasn't enough to keep things going, which is rightly so. But then we talk about a lot of stocks that are underperforming. Okay, stocks that have been investor quality, like your MasterCard, your Visa, your IBM, your Intel, your Google, your Humana, your CMG. Like just there's a lot of them for stock pickers. And I spoke to a very smart friend of mine also who was talking about the correlation, talking about how in November, when they just threw everything out the window, everyone's so scared of this one-to-one correlation, saying it makes things very, very dangerous. And no one cares about what company it is. No one cares about, what their fundamentals are, their projections. Just everything gets thrown out the window. So when you get that one-to-one correlation, things get beat up unfairly. So when the markets lift and if things get a little bit more clear and it's sustained, you don't only have to buy the crap stocks that got thrown out the window for tax loss selling. You could actually buy really solid companies that will go up 2 to 3 times that of the market. I actually tried to explain that to Bob today, and he used it on TV, but he talked about MGM and Baker Hughes. But anyway, so the correlation could work for you as well. So if you go back to this chart real quickly, you will see that on this, look at this V. Some things typically have to do W's or something, but here is the move down to the move up. So I'd like to see a move here to hold higher. And if you look at the weekly, it's still setting up really nice. This wide range bar to the upper end, and now it probably has to hold in here. It needs a little bit more firepower to blast through, versus that's why it stalled. So if we could again, like the lines are still here, hold here or hold here, so you have a low, a higher low, and maybe another higher low up here where you can't even wait for this dip to buy. It'll make enough pressure cookie here to break out. As far as some charts, real quick look at Apple. Did hold this long-term uptrend that I talked about. It did hold the 200-day, gave a decent weekly bar into that old resistance. Remember this little box that we talked about? So here's that box, and it's right there, so you can take a more clear-cut picture on the daily. We talked about actually, selling into this zone versus buying. I wasn't here for it, but it came a little bit off. So now we'll see what next is. I think Apple's move got a little bit more, let's not say dramatic, but it was a little bit more powerful because of what happened with RIM. It seems like RIM's playbook's not doing so hotsy-totsy, and it's less competition for Apple. Plus, I think the Galaxy also had some kind of ruling against where it can't sell. But anyway, Apple, some strategic calls there. You go look back at this one more time. When it broke on the chart here at this box formation, it was a really good short for active guys right here when it broke the 50-day. Came in. It was a tough buy. This was a tough buy because it closed dead on the 200-day. But then, if you did buy it on the 200-day, which investments, a lot of funds do, you got rewarded. And then really, once it started breaking above here, it was a little bit more of a strategic buy. I think I listed this in my, not off the charts, but maybe the price point sheet around 377. And now it deserves a pause. Maybe it comes back a little bit and then continues. But at this point, some strategic trades on the micro level. Short here, I think I covered a little early into here, and then buy on the 200-day, or if you didn't see that, here, and then there you go. Google, big time move. Look at that. That's unbelievable. But from where it was around 560 to 620 and change on a daily chart, it looks extended. But then again, if you have a bigger time frame, once you go to the monthly looks just ready to rumble, just to get going to the upside. On Wednesday, I did a call with Alex Steele on the street. I posted it just about what Wednesday meant and what it meant for some of the banks. And we said that there's easy room and there's tough room. Goldman Sachs was, I think, like 92 to 94. I'm like, you know what? Goldman Sachs could go to 98 to 102, right? That's a decent sized bounce. You could play it for that oversold bounce, but then after that, you have to figure out if there's more to it. So if you look at Goldman Sachs, on the daily, you will see if I get the data that it went somewhat close to that area, and you come back to me while the chart's trying to load up, where it reached the top end of it and then sort of started to fail. So you don't always have to be there for the whole trade. You're there for the the strategic part of it. So if you take a quick look here, here is Goldman Sachs. I guess it's not taking the data right now because someone might have logged in. Let's see. Nope. But it went, right to this upper resistance area, which is where it broke down from, right around this 102. So I guess I don't have any more charts right now. But anyway, that's where it went to. Okay, after it made a higher low. This was a nice buy inside day yesterday, and then it crossed this downtrend, and then pow. So all in all, lots of things to do. It all depends on what your time frame is, what you're looking to get out. Sometimes, like I said, it's better to be an investor, versus a trader. Sometimes it's better to be a trader. But I think most of the time, being a trader is going to win out. You just have to learn how to put your time frame, get it a little longer, learn how to take advantage more of daily or few week type moves versus just intraday. And once you can combine all the worlds, it becomes a powerful thing because you could then hold quality stocks in your macro account for the longer term, let the market make you money. Then you could also make daily cash flow, which does happen if you follow this, the right rules, because they usually consistently work over time. So now next week there's a huge obstacle next Friday when the leaders meet in Europe once again. You also have a lot of economic data along the way. So a slight pause would be healthy. We talk January effect stocks. You're going to see some battered and bruised stocks lift that have been sold for tax loss purposes. I talked real quickly about how X could be one of them. It started to break a little bit above. I'm not sure if this is the right chart with today. Let's see if the spiders came back up. Okay, well, that came back up. So, there's going to be a lot of different types of strategies. Typically, if you trade for the January effect, they're not always the perfect setup. You have to say, okay, I'm going to buy this group of stocks. I'm going to hold it from December through the third week of January or so, and just let it work itself out. Almost like do it and, close the account off, don't look at it, and let it run its course. If you're going to try and actively trade, these stocks that have been battered and bruised, you're going to drive yourself to drink. If it's on a Monday, that could be troublesome. On a Friday, it makes sense. But anyway, you just have to know if you're ready for that. And if you're just looking for setups, you have to know that that's all you want to do too. Today was one of those good setups that if you're just trading for cash flow, it took all day to happen, sell the excitement. Don't buy it. And with all that said, just take it as it comes. Don't let the highs get too high, the lows get too low. It's Friday. Enjoy the weekend. It's the holiday season. A lot of people definitely didn't make what they wanted to make. You're going to see headlines positive across the board. This will lead to better trading. This will lead to more participants in the market. This could actually lead to more volume in the markets. And all in all, as professionals, you'll learn how to handle it better, versus if all of a sudden we had a horrible week and you would feel better because you didn't make money. So with all that said, if again, you didn't perform the way you wanted to, look at why. Look at, if you had too many shares, look at if your time frame was wrong, look at if you chased things, or if you were wrong and you lost money and then you lost way too much money because you didn't admit to it. Write that down, figure that out. Writing things down in a journal is what helps develop your inner trading voice, which will keep you out of trouble and keep you profitable as you move ahead. So happy Friday. Have a great weekend. Scott Redler, T3 Live, the recap. See you at the morning call on Monday. Have a good one.